volatility ahead. That is for sure. So that's an astute market watcher, Elarian, with this perspective. Rana Gupta is Senior Portfolio Manager, India Equity Specialist at Manulife Investment Management. Rana, great to have you with us here on the program. Thanks very much. Now Jerome Powell did on Friday has been dissected, and I think in a way, as Mohammad Elarian pointed out, markets are still coming to grasp with the fact that it was a significant 8-minute speech, and he kind of hammered in the point that inflation is a big problem, and I'll do everything in my control to bring it under control. But where does what does all of it mean for India, Rana? Because we can talk about global macros and markets, but at the end of the day, investors watching this program can invest here in India or choose not to, or sit out or wait. What is your sort of sense on where India is headed in amidst all of this?
Right. Although I think most of our viewers will be investing in Indian equities, but in this globalized world, we cannot ignore the U.S. interest rates. The markets, rallied from sometime around mid-June on the hope that Fed will make a pivot to dovishness. That was clearly not coming, or not came. That was clearly did not come through at the Jackson Hole. If anything, at Jackson Hole speech, what it came through is that rates could remain higher for longer till the time the Fed has got a decisive control on the inflation. Now, that would simply mean the global rates can remain higher for longer, which, coming to now Indian markets or Indian policy space, constrains the reserve banks, and also that it may force reserve banks to tighten should the currency weaken or any of the macro events happen. We do believe that the rates can remain a bit higher for longer, and as I think other experts also pointed out, this kind of outlook where the rates are getting higher, not just US Fed, but other central bankers becoming more hawkish, geopolitical scenario uncertain, and also there is this increasing risk of inflation and all of it. Around this time, to get into the stock market, you need supportive valuation, which was the case in June. In fact, if you recall our interaction, we would have stated that the PE derating that had happened in that time in the fall, that kind of factored in most of the rate moves. Now, last time when the US bond yields were above 3% for 10-year, market traded at 15.5 PE. Today we have, in this rally, the P's have again gone up to about 17.5 times. So I think the valuation of the overall market basis right now, given the outlook, is not quite supportive.
Okay. Rana, hi, good morning. So is the summer rally over, and do we go back to the June lows?
See, again, we would not be calling specific peaks or bottoms. But I would just say that the valuation in general does not look as supportive as it looked in June. And meanwhile, we also have to remember the earnings cut have happened. Although a bit moderate, but earnings cut have happened. See, another thing that fueled this rally, and we have been highlighting this, that the earning cuts may not be as much as the market fear. Because this kind of slowdown we are seeing all around the world, it is also coming with higher inflation, not less inflation. Now, higher inflation means nominal growth will be good. So coming to India, the top line growth will be good. So even with margins lower than expected, the absolute profit delivered is still good. So earning cuts will be lower. The problem is the P ratios in a tightening liquidity and tightening rates kind of world. Also, if oil goes up even higher, that's another risk, but that is not a base case. So I think one has to find good earnings growth where the company's top line are linked to domestic economy, company's top line benefits due to, let's say, inflation, and not much exposure to crude or crude-linked derivatives, and trade such companies trading at reasonable valuation. We can talk about those sectors, but I think broadly that's what we will look into. And if we just look beyond this short to medium term volatility, I think the longer term India positive argument that we have been talking about for a long time now, led by digital economy, manufacturing, and now increasingly we are seeing pace of infrastructure improvement and all of it, that stays. But I think to the valuation needs to be a bit more supportive for the story to become even more constructive than it is today.
Okay, so you're saying that you're long-term positive on India, but in the very near term, of course, there is pressure and the fundamentals are not supportive. So if one wants to top up, what are the sectors that you like? Because we're noticing a change in trend, right? The domestic-facing sectors in India are picking up quite a bit, whether it's paints, consumption, the FMCG guys like Britannia, the auto sector. What are the spaces that you like now?
Right. I think the first thing I would like to say that the fundamentals are still good. It's just that the valuation at this point in time is not as constructive as it was in June. So with that being said, I think also if you look at the Nifty sectoral indices, the domestic or the inward looking indexes like auto, FMCG, they have done much better than IT and pharma. Banking, YTD, I'm talking YTD performance. Banking has not done as well, but we expect that to change. Also, it is in these sectors, domestic-facing sectors like auto, banks, capital goods, real estate. There we see the valuation comfort as well. The domestic-facing sector where the valuation comfort is relatively less is the consumer staples and consumer discretionary ex-auto sector. But barring that, I think the domestic-facing sector, auto, banks, then real estate and capital goods fits into the fundamental India story, and I would say the valuation is also still supportive.
Rana, so the view is a little cautious right now. Where is IT services in all of this? I mean, it gets hit as problems in US and the rest of the world grow, but it's already hit quite a bit. So at some point, it would have discounted a lot of bad news yet to come. Any thoughts?
Yes, I think for IT services, obviously with such a large portion from US and then global businesses, I think it's the top line outlook was very good until this far, but the top line outlook will get challenged. But we have to remember one thing: these IT companies are pretty resilient in their business model. So although the top line might get challenged, what can happen is that the margins can begin to hold up. So we have to look for a scalable player, diversified player with good margin defenses. Typically, the larger cap companies. Within the slightly smaller cap, or rather medium cap companies, there are a few companies that are can be looked at on the bottom up basis. But I think one has to look at businesses which are diversified and have got good margin defense in terms of their attrition pyramid.
All right, Rana, we'll leave it there today. Thanks a lot for joining us.